Hi, Larry Gaines, PowerCycleTrading.com. Well, nobody likes a losing trade. So one thing that's great about options is there are a lot of ways that you can adjust or defend a trade that starts to go against you or go wrong. So here's an example of Costco. So this is Costco, the daily chart here, and an hourly on the right. So back here last week on the 26th, we set up a trade here in our trading room at PowerCycle Trading for a long trade on Costco. It looks, it was looking like momentum was shifting back up. It was coming back to this 382 retracement level. Looked like there's good potential for it to break above that and head towards that 50% retracement. So you can see that looked pretty good there. So we set up what we call a Call Condor. And then what happened the next day, it could not get through that 382, failed. And then here on the 30th, started to kind of churn sideways, broke to the downside. So here's kind of a progression of what we did. So right here, had the original entry, then here on the 30th made the first adjustment by converting this from a call condor to a butterfly, and then today right on the open closed out the call debit spread side, took a loss there, left open the bear call credit spread, and ended up with a profitable trade. All right, so that's taken a long trade and adjusting it to a short trade for a small winner versus a big loser. So let's take a look at the option adjustment. So the original trade was set up for a pretty defined low risk trade to begin with. So this is what we call a call condor. We were long the 295.97.5 call debit spread for tomorrow's expiration, and we did set this up on the 26th last week, right there. And then we sold against it at that same point in time, the 302.5, just to kind of lower the risk and also to give us positive data, and so brought in $32 credit. So we had a maximum risk of $83. Now, when the market could not get through that 382, we adjusted this trade on the next day on the 30th, and what we did was we closed out the short bear call credit spread, the 302.5. It had dropped down to 22 cents, so it took 10 cents profit there. Probably should have left it short. And then what we did was we took that, and that adjusted down the cost of the call debit spread by $10 to 105, and then we immediately sold the 297.5 300 bear call credit spread to convert this to a butterfly, reducing the risk down now to just $50. So we went from 83 risk to 50, and then today, right here today on the open, it could not get back above these moving averages. So the first plan of action today was just to close out the debit spread. So close this debit spread at 105, close that at $55. So took a $50 loss there. But now we've got open the 55 bear call credit spread. We've got the 297.5 300 bear call credit spread open at 55 cents credit. That went out at $3, so we're basically up $1.47 profit. We'll let this expire tomorrow worthless, and this will turn this trade into actually a $5 winning trade. So we went from a potential loser if we'd done nothing of $80, which is still very defined risk, to actually making $5. So hope this helps. And if you'd like to learn more about these types of defensive strategies and adjustments, I'll be doing a course this Saturday on selling options for income profits and hedging. We'll be focusing a lot on hedging. So if you'd like to learn how to hedge your positions, and it's a good time to do it, coming into markets is very, very extended, join us for this Saturday. Hope it helps. Talk to you on my next video update.